Picture the single most terrifying morning imaginable for anyone with a retirement account. A morning where, before the opening bell even rings on Wall Street, tens of millions of ordinary investors, from 22-year-olds with a trading app on their phone to 70-year-olds pulling up their brokerage statement over morning coffee, all arrive at the exact same panicked conclusion within minutes of each other. Sell everything, right now, before it's too late. Not trim a position, not rebalance a portfolio. Every share, every mutual fund, every retirement account, all at once. Meet Michael, a 55-year-old mechanical engineer living outside Denver, Colorado, who has spent nearly 3 decades quietly funneling a percentage of every paycheck into his 401k, trusting the slow, boring, unglamorous math of long-term investing to eventually fund a comfortable retirement. His wife Karen has 4 years left before she plans to leave her job teaching high school chemistry. Together, their retirement portfolio sits just under $900,000. And like the overwhelming majority of American households approaching retirement, most of that number lives inside the stock market rather than a savings account. Then, on one extraordinary Tuesday morning, something genuinely unprecedented happens. A wave of fear, amplified by misinformation spreading across social media faster than any single news outlet can correct it, convinces an enormous share of the investing public that the moment has arrived to get out completely. Within seconds of the market opening, sell orders flood exchanges faster than any buyer can absorb them, and prices begin collapsing in a way that makes even seasoned traders' stomachs drop. This exact mechanism, automated trading systems, and panicked human decisions feeding off each other in a self-reinforcing spiral, isn't some purely hypothetical nightmare. It already happened once, on October 19th, 1987, a day now permanently remembered as Black Monday, when the Dow Jones Industrial Average plunged 508 points in a single session. A stunning 22.6% decline that remains, to this day, the single largest one-day percentage drop in the history of the American stock market, eclipsing even the worst days of the 1929 crash that triggered the Great Depression. What made Black Monday so uniquely terrifying wasn't a banking collapse or a recession. It was something far more mechanical and, in a strange way, far more unsettling. A relatively new computerized strategy called portfolio insurance, adopted by institutional investors specifically to protect their holdings during a downturn. The strategy worked by automatically selling stock index futures whenever prices fell past a certain threshold. And because so many large institutions were running nearly identical programs simultaneously, the initial decline triggered a wave of automated selling, which pushed prices down further, which triggered even more automated selling, a feedback loop that fed on itself faster than any human trader could intervene or even fully understand what was happening in real time. One trader who lived through it later recalled that before 1987, investors who sold aggressively into a falling market usually did so because they had no choice. They were facing margin calls. Portfolio insurance changed that completely. Because these institutions weren't choosing to sell in a panic, they were contractually obligated to sell into the falling market regardless of what they actually believed the stocks were worth. In the direct aftermath of Black Monday, regulators implemented an entirely new piece of market infrastructure, specifically designed to prevent a repeat, something called a circuit breaker, a mechanism that automatically pauses trading market-wide once losses reach certain severe thresholds. The modern version of this system, refined many times since 1987, works in 3 escalating stages measured against the S&P 500's decline from the previous day's close. A 7% drop triggers what's called a level 1 halt, pausing all trading across every exchange in the country for 15 minutes. If the decline deepens to 13%, a level 2 halt kicks in, again pausing trading for another 15 minutes, and if losses reach a full 20%, a level 3 halt closes the market completely for the remainder of the trading day, with trading only resuming the following morning. These mechanisms are not designed to stop a decline from happening. They're designed to buy exactly one thing that panicked markets desperately lack in the moment, time, a brief window for information to circulate properly, and for cooler heads to actually process what's happening rather than reacting purely on instinct and momentum. Since their introduction, market-wide circuit breakers have actually been triggered remarkably rarely. Most notably during an October 1997 mini-crash tied to the Asian financial crisis, and then repeatedly during a single chaotic stretch in March of 2020, when uncertainty around the emerging COVID-19 pandemic triggered the mechanism 4 separate times within just 10 trading days, something that had never happened before in the history of the modern system. Michael watches the value of his retirement account fall by well over $100,000 within the first hour of trading, and what strikes him most isn't just the speed of the decline. It's something his financial advisor later explains carefully, that in this kind of scenario, the fundamental mechanics of how markets actually function start breaking down in a very literal, structural sense. Every single transaction on a stock exchange requires exactly one willing buyer matched against exactly one willing seller. There is no other way for a trade to occur. When the overwhelming majority of market participants all want to sell at nearly the same instant, and comparatively few are willing to step in and buy, prices don't just drift downward gently. They can gap violently as the available buy orders sitting in the order book get exhausted almost instantly, forcing sellers to accept whatever price the next available buyer happens to be offering, which in a true panic can be dramatically lower than where the stock was trading just moments before. This is precisely the dynamic that made Black Monday so severe and that made March of 2020 briefly so terrifying. Liquidity, meaning the depth and willingness of buyers actually standing ready in the market, can evaporate astonishingly fast, exactly when it's needed most, and once it does, price discovery essentially breaks down until enough new buyers are tempted back in by prices low enough to look genuinely attractive again. The March 2020 episode offers the clearest recent case study of exactly how fast and how severe this kind of event can get. The S&P 500 fell roughly 34% from its February 19th peak to its March 23rd trough, a decline compressed into barely 5 weeks, making it one of the fastest bear market descents in the history of the index. On March 16th alone, the Dow Jones Industrial Average dropped nearly 3,000 points, a 12.9% single-day decline that stands as the largest one-day point drop in the index's entire history and, in percentage terms, actually exceeded the decline recorded on the infamous Black Monday of 1929 that helped usher in the Great Depression. The VX, an index that measures expected volatility and is often nicknamed Wall Street's fear gauge, spiked to just above 82 during this period, its highest reading since the depths of the 2008 financial crisis, reflecting just how much uncertainty and disagreement gripped market participants about what might happen next. Yet what makes the COVID crash such a genuinely important case study isn't just how fast it fell, it's how fast it recovered. According to a comprehensive Morningstar review spanning 150 years of market history, the COVID downturn of March 2020 ultimately staged the fastest full recovery of any crash on record, regaining its prior peak in roughly 4 months, a stunning contrast to the multi-year recoveries that followed other severe downturns. The dot-com crash of the early 2000s and the 2008 global financial crisis, by comparison, each took roughly 6 years for the broader market to fully claw back to its previous highs. Since 1950, the S&P 500 has experienced 13 genuine crashes, defined as declines of 20% or more, and the average decline across those 13 events runs close to 33%, with an average duration of roughly 338 days from peak to trough, and an average full recovery time of around 2 years and 2 months once the bottom is reached. But averages in this specific context can be genuinely misleading because the actual dispersion of outcomes is enormous. Some milder downturns fully recover within a matter of months, while a small handful of the most severe episodes, most notably the crash that opened the Great Depression in 1929, took as long as 25 years to fully recover in nominal terms. This wide variance is precisely why financial advisors so consistently warn against trying to predict exactly how a given crash will unfold in real time, since even experienced professionals cannot reliably distinguish in the moment whether a given decline will resemble the 4-month COVID recovery or the multi-year recoveries that followed 2000 and 2008. There's a specific, well-documented statistical reality that makes panic selling during exactly this kind of event so genuinely dangerous for long-term investors like Michael and Karen, and it centers on something researchers call the clustering of extreme days. Detailed studies of market history have repeatedly found that the market's best single trading days and its worst single trading days tend to occur in tight clusters right around each other, often within the same turbulent week or even the same few days, rather than being spread evenly across calendar time. One widely cited analysis found that of the 30 single best trading days recorded in the market over a 30-year stretch, a full 24 of them occurred during 3 specific crisis periods: the dot-com bust, the 2008 financial crisis, and the COVID-19 pandemic, meaning the very moments that feel most terrifying to remain invested through are often exactly when the sharpest, most valuable rebounds actually occur. Separate long-term research modeling what happens to an investor's returns if they simply miss the market's best days, whether through panic selling or attempted market timing, found that missing just the 30 best trading days over several decades could slash total returns from a healthy double-digit percentage down to a mere single-digit return. And missing the 90 best days could reduce an investor's entire multi-decade return to barely above 3%. This single statistic explains almost everything about why financial advisors so consistently counsel clients to stay invested through even the most frightening declines, because the investors who panic and sell during the worst days very often end up missing the best days too, since nobody rings a bell to announce when the bottom has actually arrived and the rebound has begun. There's a modern wrinkle to this entire scenario that didn't exist during Black Monday in 1987. And it actually makes a coordinated, simultaneous selling event somewhat more plausible today than it would have been decades ago. Program trading, the computerized strategy blamed for accelerating the 1987 crash, accounted for roughly 10% of total trading volume at the time. Today, algorithmic and computer-driven trading strategies account for a dramatically larger share of daily market activity, and while modern circuit breakers and other structural safeguards were specifically designed in response to lessons learned from 1987, market analysts have continued to express a nagging worry that automated systems, all trained on historical patterns and reacting to the same incoming data streams, could theoretically synchronize their selling in ways that intensify a decline faster than human traders alone ever could. This concern isn't purely theoretical. A separate, smaller-scale event known as the 2010 flash crash saw the Dow Jones Industrial Average plunge nearly 1,000 points and then recover almost as quickly within a span of roughly 36 minutes. An episode regulators later attributed partly to automated trading algorithms interacting with each other in unexpected ways during a period of already elevated market stress. The lesson embedded in both 1987 and 2010 is remarkably consistent, even decades apart, that technology designed to make markets more efficient during normal conditions can sometimes behave unpredictably during genuinely abnormal ones, which is exactly why regulators have continued refining circuit breakers, individual stock trading pauses, and other safeguards in the years since. There's also a global dimension to an event of this magnitude that deserves attention, because American markets don't exist in isolation from the rest of the world's financial system. During Black Monday in 1987, the panic didn't stay confined to Wall Street. Stock markets in Australia, Hong Kong, and across Europe all suffered brutal declines within the same trading window, wiping out billions of dollars in market value on a genuinely global scale within a single day. A similar pattern played out decades later when markets in Japan, South Korea, and Taiwan triggered their own circuit breakers in sympathy with sharp American sell-offs. A reminder that in an interconnected global financial system, a severe enough shock to American markets inevitably ripples outward to exchanges operating on entirely different continents and time zones. Pension funds, university endowments, and sovereign wealth funds around the world hold enormous positions in American equities, specifically because the United States represents such a large share of total global stock market value, meaning a crisis of the scale Michael and Karen are living through would almost certainly force institutional investors on multiple continents to simultaneously reassess their own portfolios, further amplifying the initial wave of selling before value-oriented buyers eventually step back in. University endowments in particular illustrate this dynamic well, since these institutions typically rely on a fixed percentage draw from their investment portfolios each year to fund scholarships, faculty salaries, and operating budgets, meaning a severe and sustained market decline doesn't just produce an uncomfortable headline for a university's finance department. It can directly translate into tighter operating budgets and delayed capital projects for years afterward if the recovery drags on the way it did following 2000 and 2008. This is precisely why institutional investors of this scale tend to maintain far more diversified portfolios than most individual investors, spreading exposure across domestic equities, international markets, bonds, real estate, and other asset classes, specifically so that a severe decline concentrated in one single market, however historic, doesn't threaten their entire long-term funding model all at once. Michael's own financial advisor uses this exact principle to reassure him during their post-crisis conversation, pointing out that Michael and Karen's own retirement portfolio, spread across domestic stocks, a meaningful allocation to bonds, and a modest cash reserve, absorbed this crisis somewhat better than it would have if their entire nest egg had been concentrated purely in the most volatile growth-focused segments of the market. A smaller scale echo of exactly the same diversification logic that guides pension funds and endowments managing billions of dollars. Michael's financial advisor eventually walks him through the practical strategies that history suggests actually help investors weather this kind of event without permanently damaging their long-term financial position. Dollar cost averaging, the practice of continuing to invest a fixed amount on a regular schedule regardless of whether the market is rising or falling, means that during a severe downturn like this one, each regular contribution is automatically buying more shares at lower prices, effectively lowering the average cost basis of the entire portfolio over time, rather than requiring anyone to correctly guess where the exact bottom will occur. Periodic rebalancing, the discipline of periodically adjusting a portfolio back toward its original target mix of stocks, bonds, and cash, produces a similar effect almost automatically, since a severe stock decline naturally leaves a portfolio underweight in equities relative to its original target, meaning a disciplined rebalancing process forces an investor to buy additional shares precisely when prices are depressed without requiring any emotional judgment call in the moment. Neither strategy requires predicting anything about the future. They simply take advantage of the mathematical reality that markets have historically trended upward over long periods, despite frequent, sometimes severe interruptions along the way. Karen, watching her own retirement timeline suddenly feel dramatically less certain, starts asking the exact question that keeps financial advisors awake during genuine market crises: whether 5 years really is enough time to recover from a decline this severe. Her advisor's honest answer captures something important about how this kind of crisis actually affects different people very differently depending entirely on their personal timeline. For Michael and Karen, who are still years away from actually needing to draw down their retirement savings, history strongly suggests that staying invested and continuing regular contributions gives their portfolio the best realistic chance of not just recovering, but eventually surpassing its prior value, precisely because they have enough runway remaining to ride out even a multi-year recovery if the current crash turns out to resemble 2008 rather than 2020. But for someone already retired and actively withdrawing money to cover monthly living expenses, the exact same market decline carries dramatically higher stakes. Because being forced to sell depreciated shares just to cover this month's bills locks in losses permanently in a way that simply waiting out the storm does not. This asymmetry, where identical market conditions produce wildly different real-world consequences depending entirely on an individual's specific timeline and cash flow needs, is precisely why blanket advice to just stay calm and stay invested, while broadly true on average, still requires real nuance depending on where someone actually stands in their own financial life. Meanwhile, the disruption Michael and Karen are living through doesn't stay contained to brokerage statements and retirement account balances. It visibly bleeds into the physical economy around them within days. Historical survey data gathered after the 2008 financial crisis found that fully 58% of employees reported their 401k account values had declined over the preceding year, with 37% describing the drop as severe rather than mild. And in the years that followed, roughly a quarter of workers actually stopped contributing to their retirement accounts entirely, while 2/3 of those who kept contributing meaningfully scaled back how much they were setting aside each paycheck. This pattern reflects something economists call the wealth effect, the well-documented tendency for households to adjust their everyday spending, not just based on their actual current income, but based on how wealthy they feel looking at their overall net worth, meaning a sudden collapse in retirement account values tends to ripple outward into reduced restaurant visits, postponed car purchases, and delayed vacation bookings almost immediately, well before anyone has actually sold a single share or experienced any change in their monthly paycheck. Karen notices exactly this pattern playing out around their own neighborhood within the first week. Quieter restaurants, fewer customers browsing at the local car dealership, and neighbors quietly mentioning that they've decided to postpone this year's vacation until things feel more settled. None of this happens because businesses have stopped producing goods or because employees have stopped showing up for work. The actual productive capacity of the economy, its factories, its workers, its technology, its ability to build things and solve problems, doesn't disappear simply because a stock price on a screen has fallen. What changes, at least temporarily, is confidence. And confidence turns out to be one of the most powerful economic forces there is, capable of slowing hiring decisions, delaying corporate expansion plans, and tightening the availability of credit throughout the broader economy, even when the underlying businesses involved remain fundamentally healthy and profitable. As the days pass in Michael and Karen's ordeal, something quietly predictable starts to happen, the exact pattern that has repeated after essentially every severe market decline in modern history. Long-term value-focused investors, large pension funds, and patient institutional buyers gradually start stepping back into the market, recognizing that many fundamentally strong, profitable companies are suddenly trading at prices dramatically below where they stood just weeks earlier, for reasons that have far more to do with collective fear than with any actual deterioration in those companies' underlying business operations. This is the single most important lesson Michael eventually internalizes from the entire experience: that a stock's price at any given moment simply reflects what investors happen to be willing to pay right then, under whatever emotional and informational conditions currently prevail, and that price can drift meaningfully far from what a careful, rational analysis would suggest. The underlying business is actually worth, in either direction, whether pushed too high by excessive optimism during a boom, or pushed too low by excessive fear during a panic. Weeks later, as the acute crisis genuinely begins fading, confidence doesn't return because fear has magically vanished overnight. It returns, gradually, as businesses keep operating, employees keep showing up, consumers slowly resume spending, and investors collectively shift their attention back toward the actual long-term economic value companies are creating rather than the short-term headlines dominating every news cycle. Looking back on the entire ordeal once markets have genuinely stabilized, Michael arrives at a conclusion that echoes almost exactly what serious market historians have documented again and again across nearly a century of financial crises: that the greatest danger was never really the falling prices themselves. It was the seductive, very human belief that a temporary, terrifying moment somehow permanently redefines the future. Markets have experienced brutal historic declines before, 1929, 1987, 2000, 2008, 2020. And in every single case, however long the specific recovery took, the broader economy's underlying capacity for innovation, productivity, and growth ultimately reasserted itself once the acute panic passed and rational buyers returned to the table. In the end, if every American genuinely tried to sell every share of stock they owned on the very same morning, the immediate result would almost certainly be the most historic single episode of market volatility ever recorded, triggering circuit breakers repeatedly, testing the entire market's underlying liquidity infrastructure and rippling out into real, measurable economic disruption through reduced spending, delayed hiring, and tighter credit conditions for weeks or months afterward. But it would also demonstrate, in the starkest possible terms, an essential and surprisingly reassuring truth about how financial markets actually function underneath all the noise, that prices are ultimately driven by the interaction of supply, demand, and collective confidence, that markets absolutely can and do fall with breathtaking speed when fear dominates the collective psychology of millions of investors acting simultaneously, but that genuine long-term value continues being created the entire time by the actual companies building products, employing workers, and solving real problems in the background, regardless of what any single day's closing price happens to say. The single biggest lesson embedded in this entire hypothetical nightmare is one that applies just as powerfully to an ordinary household's retirement account as it does to the trillion-dollar portfolios managed by the world's largest pension funds, that successful investing has far less to do with correctly predicting tomorrow's terrifying headline than it does with maintaining enough perspective and discipline to stay rationally positioned through today's uncertainty. Panic, as history keeps demonstrating with remarkable consistency, can spread through a market in a matter of hours, propelled by nothing more than fear feeding on itself. Rebuilding genuine confidence, on the other hand, the kind that actually drives a durable recovery rather than just a brief technical bounce, tends to take considerably longer, but it has, without exception across every major crisis in modern financial history, eventually arrived.